Silver has a very strong chance between now and year end of taking out the old dual highs at $50. I guess they're phantom highs anyway. They were hardly up there at all in terms of duration, and going into the $60, $70 range. And I'm not saying that's a top. I'm just saying that's the next pause point maybe. But I think that the important part is the surge. I think silver could basically double. That's what I'm saying over the next 6 months. Now, gold will go up nicely too, but silver will outpace gold on a percent basis. So that personally, that's my focus.
Yeah, and you're still dealing with pretty much a 100 to 1 gold to silver ratio or silver to gold ratio.
It's ridiculous, yeah. No, it's historically cheap, yeah. It's firming. Silver's firming versus gold.
Momentum appears to be shifting within the precious metals market, with silver increasingly emerging as the asset to watch as we head into the second half of 2025. While gold continues to maintain its role as a safe haven asset amid macroeconomic uncertainty, silver is gaining traction due to a combination of technical positioning, valuation metrics, and strengthening industrial demand. Market analyst Michael Oliver highlights recent developments in the CFTC Commitment of Traders. COT reports as particularly notable. Speculative short positions in silver have surged to over 120,000 contracts, significantly outweighing long positions. At the same time, commercial traders, often seen as the more informed side of the market, have been steadily increasing their net long positions. This divergence, Oliver suggests, sets the stage for a potential short squeeze should industrial demand accelerate or macroeconomic sentiment shift in favor of silver. Adding to silver's bullish case is the historically elevated gold-to-silver ratio, which has remained above 100 to 1 in recent weeks. This level, rarely sustained for long periods, suggests silver is significantly undervalued compared to gold. Analysts note that previous compressions in the ratio, such as those seen in 1980 and 2011, preceded strong silver outperformance. According to WisdomTree and others, a return to a more normalized ratio of around 80 to 1 could coincide with silver rallying to the $40 per ounce mark, particularly if gold remains firm above $3,200. Meanwhile, silver's industrial applications continue to grow. The Silver Institute projects 90 million ounces of demand from the EV sector alone in 2025, while global supply remains constrained, with a projected annual deficit of 149 million ounces. Oliver also highlights that, as the Federal Reserve is expected to pivot toward rate cuts in the coming months, the resulting decline in real interest rates would enhance the appeal of non-yielding assets, such as silver. Inflationary spending on infrastructure and green technology could act as an additional tailwind. Unlike gold, silver's dual identity, as both a monetary and industrial asset, positions it to benefit from both safe haven flows and a resurgence in manufacturing and clean energy investment. Michael Oliver emphasizes that while gold remains fundamentally strong, silver's relative undervaluation, tightening supply, and favorable macro backdrop could allow it to outperform on a percentage basis, potentially doubling in price by early 2026 if current conditions persist. Now, we present the clips from Michael's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
So, yeah, we're negative on the stock market. We're very positive on the monetary metals. We think in the next 5 to 6 months, you're going to see, for example, gold continue up, but silver explode.
It looks like it's already exploding today, and we're up to 36.50 today. It's up almost 50 cents.
Yeah, no, you're using the spot contract there, I think, or spot. Yeah. We use September silver right now, and September is trading at 36.70 something. But you'll see the explosion that occurred in April, and it blew through the two $35 highs that existed. Mm-hmm. One was in last October, and then there was a $35 high in March, those two peaks. Yeah, so double top. They tried to break down hard in early April, trying to act like they're the stock market, which they're not. Silver follows gold and always does. Exploded through those highs and has held its ground despite constant selling for the last 4 weeks or so. I think you touch 37 again and you're going to be gone. In other words, they're going to realize this isn't topping. This is just a pause. I think silver has a very strong chance between now and year end of taking out the old dual highs at $50. I guess they're phantom highs anyway. They were hardly up there at all in terms of duration. And going into the $60, $70 range. And I'm not saying that's a top. I'm just saying that's the next pause point maybe. But I think that the important part is the surge. I think silver could basically double. That's what I'm saying over the next 6 months. Now, gold will go up nicely too, but silver will outpace gold on a percent basis. So that personally, that's my focus.
Yeah, and you're still dealing with pretty much a 100 to 1 gold to silver ratio or silver to gold ratio.
It's ridiculous. Yeah, no, it's historically cheap. Yeah, it's firming. Silver's firming versus gold.
Yeah, this is silver relative to gold, so you can see the
long way back. These are very. In other words, if this were a price chart and you know it's not going to zero, what do you think about here? Are you bearish, or you look, hey, maybe this is a bargain? Okay, it ain't going to go to zero. Okay, and I think that next upturn could easily take you up to there. You've got it expressed the way we do, to the 2% level easily. In fact, if you go back, you go back quite a ways here. The number of in the past 50 years, going back to the mid 70s, where we get up there to 6.5%, silver has reached 2% in 21 of those 50 years. So it's almost routine to be at least 2%.
Right.
And we're right now 1.09, okay, almost 1.1%. So it could double in relative performance just to get to the 2% level, which isn't that's not even a big achievement.
And that's assuming gold stays constant.
If we stay gold's going up during that time.
Mm-hmm.
It's just that silver's going to go up. Instead of being 1% of the price of gold, it'll go to 2%. Because whenever the spread goes up, by the way, the metals both go up. It's never a case that silver doesn't go down and gold goes down more. It's always the case that when this spread rises, silver is going up more than gold. Deficit spending and so forth that is ongoing. There's guys like him that don't quite latch on to the Trump movement. So I could easily see, especially if certain things happen that aren't supposed to happen, like commodity inflation comes back. Well, why is that happening? Trump, et cetera, that you could have fragmentation there. So maybe the two-party system will evolve into something else, like a multi-party system they have in a lot of countries, very fragmented. All kinds of changes like that could occur exterior to the markets and are likely to occur, because I think these market events are going to be very impactful to the average guy.
Yeah, especially in regards to some of the younger demographics. I mean, I'm probably younger than a lot of people that watch my content. I can tell you a lot of my friends do not associate with either Democrats or Republicans. They're kind of they're both antiquated parties.
But
so
a lot of things like that up in the air. The 52 card pickup, I think, is coming not just in markets, but in. By the way, there's one market we haven't mentioned. I want to mention dollar index. Dollar index has been dull, dead quiet between 2023, 2024, and even into early part of this year, where you could, if you got a chart of the dollar index, you had that run up into 2015, and then you dropped hard into 2023 through 2024, and you stayed in a narrow little range. It was about 8% wide for 2 years. When they tried to break out of it, we put out a report saying, don't trust the rally. It's a breakout on the price chart, but it's baloney. It won't sustain. But it didn't. In March, the first hard month off that high, we went major bearish, because you've got a trend line here on price, but we had one on momentum that broke way up there at 104 level.
Okay.
That would be in March. Okay. We dropped down to 124 close was that month. And then you dropped hard into April, May. June is now blown through your price trend line, but it's also blown out another annual momentum structure at that point. We're maximally bearish on the dollar index. But what's happened here is here's a major factor in markets, the Forex exchange rates. This is primarily the dollar index is primarily the euro and the yen. Combined, they constitute 70% of the dollar index. Okay. But there's nothing been going on between 23 and 24 in terms of any volatility. So it was not a wave maker. It didn't have impact in other markets. Now, I understand that foreign investment in the U.S. stock market over the last few years has grown to levels it's never been before, very high. But they are affected by not just the price of the S&P, but by, they took the euro and the yen and bought dollars and bought our stocks. Okay, so they're dollar vulnerable. So if the dollar suddenly drops from where we said sell it at 104 in March, 104, it's now down to 96. That's starting to have an impact on somebody who holds assets in the U.S. Forget whether that asset went up or down, but suddenly you've chopped that much off the conversion value of that asset.
Right.
So that could help weaken the stock market, and also maybe people who own long U.S. government debt market. They're being impacted by this. While the bonds are sideways at a strangle level, in conversion terms to a yen or to a euro, you're getting hurt.
Isn't this jet fuel for a lot of commodity companies though? Because a lot of commodity companies are based out of Canada, Australia, foreign currencies.
I think it will help assist gold. It's not a primary driver for gold. In the long term, it is. Ultimately, the degradation of money is always an underlying factor for gold prices. In the short term, it's suddenly taken a sharp drop, and if it starts to drop more precipitously, that will turn heads, and that will help fuel gold more. But also the commodity complex looks ripe to do just the opposite of what you're seeing here. You're getting a major breakdown in the dollar after a couple of years of sideways. Well, what did Bloomberg do? Went sideways between 23 and 2024, bottoming. This guy went sideways, topping between those same years. And now suddenly he's broken out to the downside. Bloomberg is 3.5 points away from breaking out to the upside on our long-term metrics, annual momentum. Right now it's around 103. You get to 106.50 on a monthly close, and you're out of here. So it's an inversion of the commodity complex. You're right. So I think it will be a further fuel for the commodity markets and the stocks related to them. Yeah.
Recent market developments have raised alarms among seasoned analysts, suggesting that despite new highs in key indices like the S&P 500 and NASDAQ, the underlying structure of the financial markets may be far more fragile than it appears. According to Michael Oliver, the current rally resembles classic topping behavior seen before major crashes, such as in 2007, where surface-level gains masked deeper momentum breakdowns. In recent months, markets appeared to stagnate at elevated levels before finally unraveling between February and April 2025. While a bounce occurred near the 4,800 level, an area Oliver had identified as a technical support from a previous high in 2022, it was not indicative of renewed strength. Rather, it was a reflexive oversold reaction, one that typically occurs even within longer-term bearish trends. As Oliver notes, history shows that such rallies often lull investors into complacency, even as key momentum indicators remain broken. What makes the current environment more concerning is the uneven performance across various market sectors and assets. While the S&P 500 and NASDAQ 100 have made marginal new highs in mid-2025, many other major indexes have failed to confirm those gains, reflecting underlying market fragility. The so-called Magnificent Seven tech stocks, which once led the market surge, are showing signs of leadership thinning, with Apple, Amazon, and Tesla underperforming and leaving Nvidia and Microsoft to carry much of the momentum. At the same time, investors are increasingly turning to traditional safe havens, such as gold and silver, amid growing uncertainty. Gold continues to serve as a reliable store of value during turbulent times, while silver benefits from both its precious metal status and rising industrial demand, particularly in the electric vehicle and renewable energy sectors. Michael Oliver emphasizes that these precious metals could provide critical protection against the volatility looming in equity markets, underscoring the importance of diversification in the current climate.
I think that the next 6 months, the next couple of quarters are just going to be pretty dynamic in most markets, including some markets that have been dead asleep for a couple of years. I'll get into that in a minute, but stock market first. We turned bearish on the S&P in early January of 2005. And 2 weeks later, it went up and made a marginal new high. And it's clustered up there for quite a few months. You'll see it's just sort of, new highs, but it really wasn't going anywhere. But anyway, it finally fell apart February, March, April. Okay, and we had news at the tail end of that, the tariff stuff. Okay, fine. When the drop began, we put out a report projecting that there would be a bounce point. And the bounce point we projected would be 4,800 area. And the reason for that was back in 2022, there was a high at 4,800. And we figured the price guys would buy the old high. Okay, yeah, you see it there. Now, there's other reasons, too. There wasn't just the silly price chart line across the thing. it was some momentum reason said, no, when you get there, you're going to be oversold. You need to bounce. Even if you're in a bear trend, you get oversold from time to time. You need to correct upside.
Right.
And sure enough, it bounced, and we didn't project that it was going to make a new high. But we have focused on our prior history of stock market tops and what we've said and so forth. And when we go back to 2000, there are two major bull tops in the last 25 years. 2000, the dot-com high, and the other one was 2007, prior to the mortgage real estate crisis. In 2000, when you made the high, in January, the first trading day of that year, 2000, we put out a report that said, okay, be gone. Okay, You go a little bit further to the left there. Just prior to that drop, you see that just right under the hand, there's a little drop there. Yeah, that was from January through February. And then you turned back up and made a new high in March. That's that peak candle there. Yeah. It wasn't major high, but it was a new high. And people said, oh, you see, you were wrong. We said, no, this is a top anyway, because price may be doing this, tease you with a new high, marginal. But momentum says, no, you've broken the backbone of this beast. And therefore, any rally you get is counter to the momentum trend. Okay. Structural breakage. It wasn't corrected by that rally in March, but it made the longs feel very comfy. And if you look, it wasted the entire year of 2000 laboring either side of your first circle there, that little circle in January. I mean, it was up and down, but it wasn't going anywhere. But yet it felt good because you'd made a new high. In fact, in August, on a monthly closing basis, that was a new high monthly close. It was only in the rollover there. See that first drop you see into early 2001? Yeah, let's start there. That low that you see where there's a spike rally after that. Go further to your left, back over to take your crosshairs up to the left. Anyway, you got down to 1,300 and something and then bounced. That was a Fed rate cut. The first rate cut they'd had it over a year. They'd been in pause mode.
Oh, here, back.
Yeah, no, further left. Yeah, here. Right there. That was a rally caused by a Fed rate cut. They had ceased cutting rates a year earlier. Okay, and it was in other words, you're in a pause. They came in January and said, oh, no, they cut rates twice that month. In fact, if you shorted into the rally that followed those rate cuts, you nailed it pretty good because then the bear market really started. Even in January of that year, 2001, you weren't really that far off the highs. People didn't realize you were in a bear market. It was only later in 2001 that you started to come apart. But they cut rates all the way down. But it commenced, the real bad part anyway of the bear market, commenced with the Fed cutting rates. It's like a tombstone. Okay. Yeah,
so
you see
the
they started cutting.
here?
Yeah, see, there was a plateau there where they ceased rate rises. And then they cut all the way down. And did that help the market? No, of course not. Okay. Now, when you go to 2007, and you can start in 2006, if you will, and go to 2007, you'll see further over 2006. Anyway, at the end of 2006, the market was in the 1300s, still below its 2000 price high, which had been 1550, okay, in the year 2000. You're still laboring your way back up there. It's now 6 years later. You've wasted, if you didn't get out in 2000 and avoid the bear market, you're still less than break even where you were in 2000. Okay, but all those years, you finally came up there, and in late 2006, we put out a report. It was December of 2000. The price then was about 1,300 something. Okay. We said, you're going to top next year in a range between 1,550 and 1,600. In other words, we were suggesting that the top zone would be above the high in the year 2000, which had been 1,550. In other words, we said, you're going to go take out that old high and top. Well, that's kind of outlandish statement. What, you break through an old high, you ought to go, right? I don't have a solid sense of that, except to say that I know the bubble this time is bigger than it's ever been in history. U.S. stock market bubble. You go back and look at the 1920s, the bubble that preceded that bear market that was a wipeout, like 80% drop, was nowhere near as aged or as dimensional on the upside. Look at the 2000 top. It was a nice move, but it was nowhere near the age and the dimension of what we've just seen. 2002 bear low to the 2007 high nowhere near the duration or the dimensions of the upside that we've seen. And when you look at an M2 chart, you can see why. You look at a Fed funds rate chart and you can see, especially Fed funds, but look at the money supply growth. It's hard to measure there, but it's increased over the past 10 to 15 years more than it normally does. And they've started it up again here.
Yeah, we're at an all-time high.
Yeah, they're pushing it again.
Both gold and silver are poised to reach new highs in the third quarter of 2025, with silver expected to outperform gold due to several key factors. Silver's undervalued silver-to-gold ratio, combined with ongoing supply deficits and rising industrial demand, especially from the electric vehicle and clean energy sectors, creates a powerful catalyst for price appreciation. This unique blend of technical signals and supportive macroeconomic trends, reinforced by bullish analyst forecasts, highlights silver's dual role as both a precious metal and an industrial commodity, making it a particularly attractive investment. Investors would be wise to consider strategic allocations to silver through ETFs, futures, or mining stocks to capitalize on this promising opportunity, embracing the market adage that, in a rising tide, silver swims higher than gold. How do you anticipate gold and silver prices will perform in the near future, considering current market dynamics? Share your thoughts in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.